Blockchain Capital is reportedly trying to raise $700 million for two new crypto funds, a sign that venture money still sees another build cycle ahead. Fundraising is slower and less flashy than a token pump, but it often tells you more about conviction. Blockchain Capital targets is the phrase pulling in search traffic, but the real issue is a fundraising target is not the same as a final close, and investor appetite can change if markets wobble again. For the startup market, fresh fund capacity means more runway for teams building exchanges, wallets, infrastructure, and tokenization tools before the next cycle is fully obvious. That is why this kind of story often matters most a few months later, when the money either closes and gets deployed or quietly fades. That is why the move, filing, freeze, or proposal matters right now, not just as a headline but as a test of who is exposed and what actually changes next. Then deployment matters, because a target is not yet a close. The follow-on reporting says the raise would split between early-stage and growth capital and could close within months. VC fundraising is slower than a token chart, but it is one of the clearest signals of whether sophisticated money thinks another building cycle is worth financing. Fresh fund targets can change founder behavior immediately because startups read them as a sign that capital windows may be reopening. That mechanism is what turns blockchain capital from a simple headline into a live market or policy problem. Once you see how the pressure is transmitted, the later price or governance reaction makes a lot more sense. That is where the market will decide whether this is optimism or execution. That matters because venture funding is one of the clearest ways to see whether institutions believe the next wave of startups is worth backing now. The affected group includes founders, later-stage companies, and rival VCs that now have to read whether institutional appetite is genuinely returning. At the same time, investors know the difference between a target number and a finished close. For the startup market, fresh fund capacity means more runway for teams building exchanges, wallets, infrastructure, and tokenization tools before the next cycle is fully obvious. When people type blockchain capital targets, the useful answer is not a slogan. It is the mechanism behind the move. Bloomberg, via follow-on coverage, reported blockchain capital is seeking $700 million across two new crypto funds. What is confirmed here is the core event and the immediate consequence around blockchain capital. What is still open is how the market, the regulator, the exchange, or the users respond once the first reaction passes. That means the market should treat the headline as meaningful, but not final. A fundraising target is not the same as a final close, and investor appetite can change if markets wobble again. That does not automatically decide price direction, but it does tell you where the market is vulnerable if the next update goes the wrong way. If fundraising weakens before closing, the confidence signal shrinks. If it closes fast, the read gets much stronger. The useful habit here is to separate the event itself from the assumptions people rush to stack on top of it. When the assumptions start outrunning the confirmed details, volatility usually widens before clarity improves. Blockchain capital targets is getting attention fast, yet the part traders actually need is whether the firm actually closes the funds and where it starts deploying the capital. The next signal is whether the firm actually closes the funds and where it starts deploying the capital. The follow-through worth watching is deployment, which sectors get backed first, and whether the money flows into infrastructure, consumer apps, or tokenization rails. That next signal matters because it will tell you whether this stays a one-day shock, a tradable trend, a compliance shift, or a deeper trust problem. That is the part worth tracking after the noise fades.